Queuing up our live stream, and then we will kick off here any second. So thank you again, everyone, for taking time out of your busy schedule to join us for the session. Today's session is on understanding source deductions. For those of you who are new clients to CPA for IT, this is maybe your first time tackling source deductions as an owner or manager of your business. And today we're going to go through a little bit about how our process is and how it's a little bit different from a traditional employee who's paying monthly payroll, and how to figure out how much money you're going to be taking from your corporation and how much money you're going to need to pay the government in corresponding source deductions. So without further ado, let me kick us off. My name, as I've said earlier, is Andrew Wall. I'm the managing partner here at CPA for IT. We're an accounting firm specializing in independent contractors. We've been doing that since my father founded the firm originally as Wall & Associates back in 1984. We are an ISO 9001 registered firm, which just means that we have systems, processes, and those are independently audited and monitored to make sure that we're constantly striving for constant and never-ending improvement. Our mission here at CPA for IT is to help our clients organize their finances, create wealth, and transform wealth into a legacy. Big part of that strategy is keeping money inside of your corporation and hopefully paying yourself as low a salary as is humanly possible. And we'll be explaining a little bit about why that is and how to do that. But today's session really is around payroll source deductions. So maybe we can start with a bit of an explanation on what those are and why they're important. So as an employer, you have to remit employee source deduction. Oh, look at this. We've already got our first question coming through in the chat. So we'll see if we can help Andy with his first question. So I've made a large RSP contribution through work, and as a result, my withholdings may not cover taxes due in April 2024. Can I make advanced tax payments so that I don't owe any taxes at the time of filing? Yes, you could. Although it's funny because you said you made large RSP contributions, which would actually offset your income, which would mean you should normally be paying less, not more. But if you wish to increase your source deduction payments from your corporation, you certainly can, and you have until the end of the year to do so, as far as increasing your quote unquote salary or making any source deductions. However, the caveat here is I wouldn't actually recommend that because if you're not obligated to remit anything to the government, I wouldn't pay them any earlier than you need to, because then you're giving them access to the time value of money as opposed to retaining that for yourself. So generally speaking, I would wait until April and pay what you owe in April. But if you wish to, you can make a additional source deduction payment, and we'll show you and we'll explain how to do that in this session today. So hopefully that answers your question. So again, going back to what are payroll source deductions and understanding what they are and what the deadlines are, which we're going to be talking about later today, is that as an employer, now with your own company, even if you are the only employee of that corporation, as an employer, you do have to withhold and remit CPP and EI, if it's applicable, contributions, as well as the payroll tax or employee tax for any employees that you have that you paid throughout the calendar year. And there are specific deadlines. We're going to talk a little bit about what those deadlines are. And these remittances are deemed to have been paid on the day in which they are actually received by the receiver general. So one important note, if you schedule a payment today, but it doesn't actually clear until tomorrow, that payment is considered paid tomorrow, not today when you scheduled it, which is a really important factor. And the reason it's so important is because the penalties on source deduction remittances are the steepest of any penalties, up to 20%. We're going to talk a little bit about what those are later today and how to avoid them. But these payments and source deductions have to be received before the appropriate deadlines. And we're going to talk about what those deadlines are, but to keep it short and simple, for most of you, the absolute last deadline is going to be to pay payroll by December 31st, which is the end of the calendar year, which means most of you are going to have a deadline of January 3rd to make that payroll remittance to the CRA. Now, if it does fall on a holiday or a weekend, you do have till the Monday. We'll cover that a little bit more in detail as we get through those deadlines. But now that you know what they are, so these are the taxes that you're withholding from your employee's paycheck and remitting to the government, we need to understand a little bit more about how to figure out what these are or how much these should be. So when we're trying to figure out what your payroll will be from an owner-managed company, which is what we're talking about specifically today. So these are payroll taxes for owner-managed businesses, and you're trying to figure out what your salary is going to be for yourself and how much you're going to need to pay in payroll taxes on this salary. So first, we have to ask you a couple of questions. We want to figure out whether you have any income from other sources. And that's because we're trying to figure out whether you've made use of the basic exemption, whether you've made use of the lowest tax brackets. So do you have income from other sources? And a lot of our clients might come from a full-time work experience and have started their corporation part of the way through the year. And so they'll have income already as an employee prior to incorporating and setting up their business. And if you do, how much do you have? Because if you've got a large income, maybe a severance package, something like that, you may not want to pay yourself any salary from your corporation. You may wish to take any money that you've taken out of your corporation and consider that a loan, and then declare that as salary in 2024 or in a subsequent year. And you do have a couple of options when you are self-employed as far as how and when you declare a salary for yourself or any other directors of the corporation. So what's unique about being self-employed is that you can pay yourself a bonus as opposed to a monthly salary. And for most of our clients, that's what you're going to do, is any money that you're taking out of your corporation throughout the year is considered a loan. And the big caveat here is if you take the same amount of money on the same day every single month, there is a possibility and a probability that CRA will come along and say, well, that's not actually a loan, that's salary, and you should have been paying source deductions every single month, and you now are late and you have a penalty on all of those. So if you're taking money out of your corporation, take it as you need it and only take what you need, because with a corporation only paying 12.2% tax here in Ontario, that's substantially lower than the highest personal tax rate, which can be as high as 53.5% here in Ontario. So the goal is to leave as much money in your corporation and only take out of the corporation what you need to cover your non-deductible lifestyle expenses. Now, that being said, we do want to make sure you use the basic exemption, and usually up to at least the lowest tax bracket, because even though the lowest tax bracket is about 20%, when you factor in the basic exemption, it averages to around the 12.2% that you've got inside your corporation. So if you've already made use of those basic exemptions and those low tax brackets, you may not wish to declare any salary from your corporation. You also want to take a look that if this isn't your first year, have you declared salary from your corporation from your previous corporate tax fiscal year end? Because with a corporation, as I said, you can pay yourself a bonus, and that bonus can be declared anytime throughout your calendar year and up to 6 months from the end of your calendar year. So what that means is if you have a July 31st year end, so let's say that you're dealing with a July 31st, 2023 fiscal year end, you could have salary anytime from August 1st to December 31st, 2022. You could also have salary anytime from January 1st to July 31st, which falls in your fiscal year end. And you could also bonus up to 6 months from that. So all the way up until towards the end of January 2024, which means in a July 31st, 2023 fiscal year end, you could be declaring salary in 22, 23, or 24. Now, I encourage you, if you're trying to figure out how to strategize that, to sit down with your account manager to come up with a strategy. But when it comes to calculating your remittance amount, we want to figure out whether you've leveraged and used these basic exemptions, either from prior income that you might have from full-time employment that's already been declared from your corporation, or that you might have from other sources of income like rental income or personal unregistered investments or anything other than your corporation. Next, once we've figured out that you haven't used up that space and we want to declare a salary, we have to look at a couple other factors. So first of all, how much money have you actually withdrawn since your last corporate year end? So how much money have you taken as this quote unquote director's advance or this loan from your corporation? We also want to know how much money that you'll contribute to your RSPs. It's also helpful for us to know if you have a target net income. Sometimes people might be looking to get financing for purchase of a home or any other loan, and they'll need to have at least a certain amount of income to be able to qualify for those loans. So if you do have anything like that, that's helpful for us to know. And of course, we need to know if you have any family members that you'd like to do any income splitting with. So if you've taken out $100,000, but you've got two family members that we can income split with, we can look at different strategies to reduce the amount of salary that you personally have to take. And when we split it among multiple family members, we'll lower the total amount of taxes payable. And in fact, we have sent out to all of our clients a source deduction email that asks you to complete a form. And on that, it's going to ask you these questions as well as a few others, like how much money did your business make? How much money did you pay for in expenses that are deductible to the business that you paid for through the business? And how much did you pay for in deductible expenses that are paid for with your own money? So anything that's like cash or a personal credit card. Because when we look at how much we have to declare as your salary, what we're looking at is the net director's advances. And what I mean by that is how much money that you've taken out in cash withdrawals or checks or however you're taking money out of your corporation, less any expenses that you have paid for with that money that you've taken out. So you might have your home office or your automobile that's paid for personally, and that reduces your director's advance. And we're only going to pay your salary based on the net of this director's advance. So that's the purpose of that form that we send out. And that's to help your account managers be able to do the best tax planning for you. Now, if you fill in that form and we send you a tax planning that you're not comfortable with, I strongly encourage you, even if you are comfortable with it, but it's your first year, book a consultation with your account manager once you've got the draft source deduction planning document from them. And they'll be happy to walk you through what it is, why they've come up with that amount, and of course, make any changes that we need to so that you can make the appropriate source deduction remittance. So now we want to talk about deadlines and due dates. But before we understand what the deadlines are, we do have to understand different remitter types, because there are different remitter types. By default, you're going to be a regular remitter the first time you set up your payroll account. And that's because your remitter type is based on your average monthly withholding amount, but it's actually based on your average monthly withholding amount from 2 calendar years ago. So first of all, what is your average monthly withholding amount? So this is, if you're paying monthly payroll, this would be add up all those payments that you make in payroll source deduction remittances and divide by 12, assuming that you're paying monthly. And that will give you the average monthly withholding amount. So how much have you withhold from your employees and remitted to the government on average per month? And then based on that, you could become a threshold 1 or a threshold 2, which will have different deadlines. But all the deadlines are a function of when you pay your employees. So if you're paying your employees every single month, the government's going to expect you to remit payroll taxes every single month. Now, if you are only paying your employees, which are only yourselves, once a year as a bonus, you only need to make payroll remittances once a year. It's still a monthly payment. You just don't happen to have any monthly payments that are due in any other months. As I said earlier, if the due date does fall on a weekend or a public holiday, you do get till the next business day. In addition, if your business does go bankrupt for whatever reason, you do have to pay within 7 days following the closure or the bankruptcy of your business. That's important to note, as we are seeing more and more bankruptcies, particularly with the CEBA loans and people unable to pay those loans, and bankruptcy being an option to deal with that. But that's just another important to note to be aware of. So as I said, you've got a couple different categories. You've got your regular remitter, which is what you're going to be by default for the first 2 years. And with that, you actually have until the 15th of the month following which you pay your payroll source deductions. So if you pay on December 31st, it would be due by January the 15th. You also have a threshold one, which after your second year, if your average monthly withholding amount is more than $25,000, which is where the majority of clients tend to fall, it's going to be due by the 10th of the following month. So if you paid again December 31st and you're a threshold one, your deadline is going to be January the 10th. Now, if your average withholding amount is more than $100,000, it's actually going to be due on the 3rd. Now, most of our clients don't fall under this category, but since this is a worst case scenario, you'll notice that all of our reminders and all of the deadlines that we tell people to focus on are going to be around the 3rd of January. So this, for many of you, means that if you pay by the 3rd, you've actually got it in a little bit early, which is important, particularly in your first year, because oftentimes there can be issues getting that payment over, because specifically if you use the CRA, if you go online to the CRA My Business account to pay your source deductions, that's often limited by your Interac balance limit, which is usually about $3,000. And very few payroll source deduction amounts are less than $3,000. So you probably need to make it in multiple installments over multiple days. Now, if for whatever reason you have a average monthly withholding amount of less than $3,000, you would qualify as a quarterly remitter. However, this is sort of irrelevant for most of our clients, because most of our clients, as I said earlier, are only paying themselves as a bonus once a year. So they're not needing to pay every single month. So switching from monthly to quarterly doesn't really provide any advantage. Now, if you were a traditional employer with employees that you were paying every single month and it was less than $3,000, then hey, only having to pay every quarter as opposed to every month is a benefit. And one last thing to note is that if you have any associated corporations, holding companies, or related companies, that you have to look at the combined average monthly withholding amount to determine your threshold. But again, if we focus everyone on the worst case scenario of being due on the 3rd day of the following month in which you paid your employees, i.e. January 3rd for a December payroll payment, then you don't need to worry about which type of remitter you are. Now, you also noticed in your second year, if you've been in this for a while, that you'll get a notification saying that you have moved from a regular remitter to a threshold one, or a regular remitter to a threshold two, and you need to pay by every month by the 3rd. Again, that is absolutely true. If you're making monthly payroll or if you're paying monthly payroll, you need to pay every month. But if you're doing a bonus once a year, then again, it's still only annual. Now, again, another caveat that I would say to people is that you can file a nil payroll remittance on your CRA My Business account. And what I strongly encourage people to do is, after you make your January payment, to go to the CRA site and file a nil payroll remittance voucher, which will then say, hey, I have no employees with any eligible remittances this month, and I don't expect to have any eligible remittances until next December, or whatever the case might be. Now, historically, this hasn't been much of an issue if you didn't do this. However, I did have a client that CRA sent them the letter. They didn't know what to do with the letter. They didn't do anything about it, saying, hey, how come you don't have any? CRA sent a letter saying, hey, why don't you have any payroll remittances this month? And they didn't get it because they were out of the country and didn't deal with it. And when they finally came to us and we went online, I'm like, oh, normally it's not a big issue, but let's log on to your CRA account. Well, CRA had assessed them a penalty. And this was only a couple months in, which is rare, but CRA is getting far more diligent in their reassessments and their arbitrary assessments. And so they arbitrarily assessed this gentleman's payroll account and hit him with a penalty, even though he actually didn't have any payroll remittances. So we filed the nil return that cleared everything up. But, so you don't get that stress of a letter from CRA saying you owe them, a certain amount of money, which might be based off of a bonus amount, which covered the whole year that they think you should be paying every single month. You might want to file that nil return with CRA. And again, it's pretty easy. All you're putting in is that you have no employees with any remittances for that period, and the period in which you expect to have remittances again. So as I said earlier, so new employers are considered regular remitters because there's no 2 years of history yet. So you will be a regular remitter for your first 2 years of activity. But by default, if you incorporated with us, we have not created a payroll account for you because, again, it's not uncommon for clients to have had, a severance package or full-time income prior to incorporating their business. And we don't want you getting payroll notices and notifications from CRA unless you plan to actually make a payroll remittance. Now, the good news is you can make a payroll remittance without creating a payroll account because you have a business number and your payroll account number is tied to your business number. So if you go online and make a payment either through MyCRA or through your online bank account, they'll automatically create the payroll account number for you. However, if you wish to make a payment in person at a bank or to mail a check, you will need a PD7A form, which is a specific document tied to your specific organization that is mailed to you. And this is not something that we can print or provide to you. This is something you have to get from CRA if you wish to make a payment at the bank. So if this is your first year and you're planning to make a payroll remittance and you haven't created a payroll account with CRA, you can do that through your My Business account, or you can give them a call and it's done very quickly, very easily to create the payroll account, and then they will mail you out that letter. Now it's going to be with CRA 4 to 6 weeks, so you may be in danger of not getting that in time for the deadline, which for you, the good news is will be the 15th of January. So you might just make it in time. But again, there are options, other ways that you can make payments. You can pay online banking, which is the way that I do recommend that you do your payments. Again, it's not going to be limited to that same, Interact e-transfer limit that you have with the My Payment that's available through the CRA. You can do it with credit card and debit card. There's a company called Plastique that allows you to do this. Some people have asked me in the past whether it's worthwhile to put it on their credit card so that they can get the points. I would say absolutely not, because Plastique does charge a service fee that is more than any points structure that I've ever seen with any credit card. So it probably doesn't make sense to do that. You can also pay in person at a financial institution or a Canada Post outlet. However, as I said earlier, if you are planning to pay in person, you will need a copy of that PD7A form, which is this remittance form that we're talking about. And this is, as I said, personalized to your specific identity. It's not something that we can provide for you. You will need to register for an account and they will mail it out to you. On this form, you will need to complete a couple of pieces of information. And again, if you're making a payment online, you will need to complete the same information, which is how many employees, what's your gross payroll, and what's the remittance amount. You don't need to worry about breaking up CPP, EI, and payroll tax. They just want to know what's the gross payroll, what's the number of employees, what's the remittance amount, and what's the pay period. The pay period is really important and is the thing that often gets messed up. When we get clients calling us and saying, hey, I've been assessed with a penalty from CRA, it's often because they put the wrong pay period. The most common mistake is to enter your year-end information. So imagine I had a July 31st year-end and I could bonus all the way up to January, and I make a payment, in January 3rd, but I put the pay period as July 31st. CRA is going to say, no, well, you're late. Now you're going to be assessed with a penalty on that. Whereas if I said, no, this was for, the payment would be due February 3rd, not January 3rd. So let's say that the payment was, you would say the pay period is January, and then the deadline would be in February. But if you put July, obviously you're now late and you're going to be hit with a penalty. And as I said earlier, if you're not making a remittance in any single month, then you do want to do a nil return, and that can be done online, over the phone, or by mail. So that PD7A form that they send you, which they will send you monthly, you can complete that and send that in and say, I have no employees with any eligible remittances until December of next year, or whatever the case might be. You can also do that online or over the phone. Now, if for whatever reason you have made an under remittance or an over remittance, as one of the gentlemen asked earlier, how can you fix that? So you can, first of all, you can go in and make another remittance if you like. But as I said earlier, I don't like to do that as long as you have covered the minimum CPP. So as an employer, you are required to withhold and remit the CPP. That's the bare minimum. Now, most of our clients are going to be exempt from EI, so that's not necessarily applicable. And as an employee, you are allowed to tell your employer that you might have other deductions, whether that's childcare, whether that's RSP, that are going to reduce the amount of taxes that you want withheld from your employer because you know you won't owe them come filing time. And as long as you've covered the CPP, you as the employer have done everything that you are required to do. And so if you have made a remittance that is too low, but higher than the minimum CPP, we'll usually correct this with the T4 as opposed to going and making an additional payment and risk being assessed with a penalty on that additional payment. So what we'd simply do is we'd reduce the amount of taxes withheld that we report on the T4. And now the employee who has not had enough taxes withheld by the employer, which are one and the same, will have to pay the additional taxes that they owe when they file their tax return in April. Because what the filing is doing in April is telling the CRA what you actually owe. And that's based largely off of the T4 that you're going to receive from your corporation or which you may have received from other employers that says, hey, I gave him a salary of this. I took off of his paycheck that, and I gave it to you. Now, if what I've given you is too much, then the employee will get a refund. For example, if they'd made RSP contributions or had donations or childcare expenses or whatever other deductions they might have going on the personal tax return, that will result in a refund. On the flip side of that, if the employer has not withheld enough, then they will owe the additional taxes that should have been withheld and remitted from the government. Because all the source deduction withholding is you taking that money, holding it in trust, and giving it to the government on behalf of the employee. And the reason that the penalties are so high when it comes to payroll source deductions is because it's not your money, it's the employee's money that you are holding in trust. And so the government gets very, very, very finicky when you're taking other people's money and not giving it to them. So that's why the penalties can be so steep when it comes to payroll source deductions. Now, the last issue is a misimplied payment. As I said earlier, if you enter the wrong date or CRA just makes a mistake and applies the payment to the wrong period, they might assess you a penalty. The good news is that when it comes to these misapplied payments, it's really easy to correct. We can call CRA, we can go online and adjust it through their portal, and CRA will consider the payment made the date the payment was originally made, not the date it was transferred. So if for whatever reason if for whatever reason you made the payment on time, but it was applied to the wrong period and you were hit with a penalty, once we correct it to the right period, the penalty will be reversed. Now, as I said earlier, the penalties for payroll can be significant and are significant. If you are a minute late, if you make your payment at 12:01 a.m. On the 4th, if it was due the 3rd, you're going to be hit with a 10% penalty. And since payroll taxes are one of the largest taxes that you can pay, this penalty is potentially one of the largest penalties that you can pay. In addition, if you are late on multiple periods, CRA could apply a 20% penalty for the second or later failures. So it's really, really, really important to make sure that you're making this payroll source deduction remittance on time. The good news is you have lots of time right now to get this in and get your planning together. And that's really the long and short of payroll source deductions. I want to take a minute to open it up to Q&A here. because I'm sure many of you might have other questions. I know Alex had a question at the beginning there that I think we've answered hopefully adequately. Alex, maybe you can tell me if you have any further questions, or if any of you that are live have any questions, feel free to post them here. If you are watching on any of our social media channels, one of my colleagues is doing his best to monitor it, but now that we're using Restream, it's going out on multiple platforms. If we miss your comment and don't get it pushed over to the live here, we will do our best to come back and answer those questions in the comments of the social media channel that you are choosing to watch this on. So again, I'm going to give us a few minutes. If you do have a question, please post it into the Q&A. If we don't have any questions in the next minute or so, I'll wrap it up and give you guys time back on your schedule. Again, for existing clients, please be on the lookout for the emails you should have received. If you have not received one, check your junk email. If it's not in your junk email, reach out to your account manager. We'll make sure to resend that for you so you can complete that form. Or at the very least, just book 15 minutes with your account manager. They can go through that worksheet with you to figure out how much we want to declare for you as a salary from your corporation and what the corresponding payroll source deduction remittance will be and when they will be due. So thank you, everyone. It doesn't look like there's any questions, which means I've either done an amazing job or you guys know everything there is to be about payroll. Oh, here we go. We've got another question that's come in. So as an individual, if I owe taxes on my T1 or personal tax return, will there be penalties? Most years I've received a refund from my T1 file. Yes, so as an employee, you typically probably are receiving a refund because you might have other deductions like an RSP, childcare, donations, et cetera, which reduce the amount of taxes that you owe, whereas the employer has done their calculation based on your gross payroll. So if you have a situation where you actually owe, as long as you pay by April 30th, there's no penalty. If you pay late and you file late, yes, there would be a corresponding penalty for late filing and late payment. And again, if you're going to be late in filing for whatever reason, if you pay your penalty or you pay your outstanding tax by April 30th, the penalties are a percentage of what's outstanding. So any percentage of 0 is 0, so you wouldn't actually owe. So no, and this probably ties back to that earlier question is, hey, should I make an additional remittance to cover the withholdings that weren't there? Okay, we got another question that's popped through here. Can you encapsulate the differences between paying yourself via salary or paying yourself via dividend? Yeah, happy to cover that. And again, check out our last week's webinar where we went through this in a little bit more detail. Today, we're just talking strictly about salary because if you pay yourself a dividend, there is no payroll taxes on a dividend. So there's no withholding by the corporation on a dividend. And that's because a dividend is paid out of retained earnings. So once you have paid taxes on your net income, you have retained earnings in your corporation and you can issue dividends from those retained earnings. So dividends have already been taxed at your corporate tax rate. Because they have already been taxed, you get a dividend tax credit personally, and you don't pay as much personal tax as you would on a salary. Now, there is something called the theory of integration, and this theory of integration is designed to make it such that there is no financial benefit for an owner of a business to choose a salary over a dividend, which effectively means if you add up the corporate taxes plus the personal taxes on a dividend, they should roughly be the same as what the personal taxes would be on a salary. So when we're talking just tax, there's no actual benefit of one over the other. However, there are other benefits of choosing salary over dividend or vice versa. And when it comes to dividend, the big advantage there is that you've got a timing benefit of the fact that you don't have to do these remittances in January. The employer just pays the taxes on the income, and then the shareholder would have to pay the additional taxes on the dividend they receive when they file their personal tax return in April, but there's no withholding from the employer. And so that buys you some extra time of when those taxes are due. In addition, because a dividend is not eligible for CPP or EI, it means you're not paying into those. So you don't have that cash outlay. Now, well, a CPP and EI are not necessarily the best investments in the world. You can probably do better in the stock market yourself. It is a guaranteed source of income in retirement. So we tend to recommend and encourage people to be paying into CPP. Unfortunately, over the, since 1984, we've seen all too many people who thought they had a sound financial plan only to be wiped out by a recession that they weren't expecting or a correction to the market they weren't prepared for. So making sure that you've got some CPP as a guaranteed retirement income, we do tend to value. In addition, RSPs are another effective strategy. And again, go back to our session last week to understand the differences between contributing or saving and investing inside your corporation versus an RSP versus a TFSA and all those other things. We spent a whole hour explaining the difference between the two. But that is the long and short answer of a salary versus, that's the short answer of the difference between a salary versus a dividend. So hopefully that helps. And I think that is our last question for today. So again, thank you everybody for joining us. Wish you a happy Tuesday. And don't forget to come out and check out our webinar this Friday. Every Friday, we're doing Friday Eye, which is our podcast focused around artificial intelligence. I've got a great guest this week who wrote the book on AI in accounting. Hitindra Patel literally wrote the book on the rise of the AI accountant. So hope you guys will join us there on Friday. If not, we host a webinar about every Tuesday. So come check those out. And we've got an entire list that's coming out for the new year. We've already planned the entire year's calendar of webinars. So check those out. Those will be coming to our website over the next week and should be published to Eventbrite again over the next week sometime. So thank you, everybody. Have a great Tuesday and bye for now.